Good morning, traders and investors. Thank you all so much for tuning in. Bennett with tradinganalysis.com. Hey, welcome to the show. Thank you guys for taking some time out of your Wednesday morning. March 31st, end of the trading month. Tomorrow will be the first trading day of April. Things have been interesting. Things have been really interesting in the markets. Coming off of the February 16th high in the indexes, we had the move into the March 4th and March 5th lows. The S&P, the move back in the S&P has carried us into new fresh highs. The move in technology, specifically the Nasdaq 100 as well as the XLK sector spider ETF for the tech sector, things are a little more unclear there. We have actually still yet to see a kind of a decisive move through the 61% retracement of the February 16th through March 5th decline. So that leaves open the possibility that we do get a secondary move lower there for tech. Still keeping our eye on yields. Obviously, with the dynamic at play there, it's going to potentially continue to impact high multiple and growth in tech stocks. So we'll take a look at the charts in just a minute. Our fearless leader, Mr. Todd Gordon, is not with us this morning. We thought we'd give him the morning off. He's got his Series 65 test today. He's been studying really hard. Man, is that a beast of a test. There is a lot of material there, So we'll be wishing him the best of luck. Let's bring in the trading analysis team. Good morning, Terry. Good morning, Alex. What's happening, gentlemen?
Morning, Bennett.
Hey,
good morning, Bennett.
What's happening? How are you guys today? Doing well?
Oh, just fine, just fine. Yep, couldn't be better. Tell you what, though, the tree pollen is all over the vehicles and driveway and in your lungs and your nose, so it makes you sneeze.
Isn't that the truth?
That's all part of it.
I remember the first time I saw a video down at one of the local lakes during the season, and there was some wind, and somebody was recording a video, and you just see the pollen coming off of the trees, and it was like snowing pollen. It was quite the eye opener. So. Yeah. We'll see how things go. It's still dark outside. With the time change now, it kind of throws off our mornings here. So what's happening in your neck of the woods, Alex? Doing well?
Yeah, already 3 o'clock p.m. here. Yeah, most of the things are relatively fine. We have vaccination process, all of the stuff like in the other countries, but nice weather starts to kick in, so that's encouraging.
Good.
So everybody's a little bit more in the mood.
Yeah, I've yet to get the vaccine. There's a local facility that's now offering the single-dose Johnson & Johnson version, so we'll see. I've had 4 exposures.
Good luck getting on that appointment list, though. That's
yeah,
the thing, so.
and that's a great point.
Trying every day.
Yep.
It'll be 2 weeks tomorrow. I've had since I had my first shot, so I'll get the
still feeling good
dose here in mid-April. So I'm 85% covered now, so that's a good thing. Hey, they finally got that ship out of the Suez Canal. Do you see that?
I did. What the ordeal that was. I was reading this morning an article about the backup and how long that could potentially take to kind of unwind. Obviously, not just the ships getting through that canal, but then the ports of their destination going to be, kind of backed up for a while.
Alex posted some funny little pictures on our Discord public or our private Discord chat there. You got one guy with a shovel trying to shovel this huge ship, and then they bring in one excavator, right? I was like,
oh my gosh, yeah, that was like, come on, you're gonna need a little more manpower and horsepower than that, I think.
Yeah, but as you can see, Terry, he did it on the end.
They made it happen. So
yeah, they made it happen.
All right, guys, let's get into it. We've been keeping you well past the open recently, so we're going to try to kind of narrow things down here. Let's start it off. I'll take you through the charts, hard right edge, and then when we come back from that, we'll go into sector focus, and then we'll hear from Alex. So, guys, I'll be back in a few minutes. We're going to jump into Motive Wave. What's up, YouTube? Thank you guys again for tuning in. If you do enjoy the content, please give it a thumbs up, subscribe, and turn on notifications. You can also visit us on our Trading Analysis YouTube channel, youtube.com/trading analysis. I've been posting videos there a couple of times a week, as has Terry and Alex. Alex hosts his show over there, and I'm actually getting ready to potentially launch another show on that channel. It won't be a weekly show, it'll be twice a month, but more details to follow. So let's jump into it. Hard right edge of the Motive Wave platform. We just got through with our spring sale for anybody who was able to take advantage of that. It's a great 25% discount on what is an expensive program, but if you're serious about Elliott and really just technical analysis in general, it's the only way to go. So last week we were having a discussion about the fact that oftentimes when you run into a situation such as the one you have here, and the situation that we're faced with is the fact that off of the March COVID lows from last year, the Elliott wave count is a little bit subjective. There are a couple of different valid interpretations. And oftentimes when you're faced with that dilemma, if you would, some traders and analysts have a tendency to focus too much on trying to dissect that exact higher degree count. And you know what Todd mentioned is we're still seeing the directional, the motive waves, as we call them in the world of Elliott, in the direction of the uptrend, the higher degree uptrend, which continues to be intact. The corrective pullbacks, the three-wave counter trend moves, have all been to the downside. So the market still remains in a well-contained uptrend here. We are, as you can see, kind of losing this parallel trend channel from the COVID lows. But I do think we're going to continue to see a move up here in the S&P. As I said at the start of the show, the Nasdaq and tech sector, a little bit, still a little bit of a question mark. So as it stands now, what I want to do is just look for the directional moves and the counter trend corrective pullbacks as a possible entry opportunity and a tradable support level. So what we're going to do is we're going to zoom back in here on the daily chart, and we're going to focus in on the price action here in orange wave 1 down into orange wave 2. And then we're going to talk about everything that's happened since then. So off of the daily, we're going to actually go down to a 30-minute chart for starters. And here's the move off of the March 4th low. The March 4th low in the S&P was about a measured move correction, three-wave counter trend decline. We have 5 waves up into March 16th. We then enter a series of 3-wave moves. And this series of 3-wave moves told me that the price action in the S&P was counter trend and corrective. This was not a motive trend establishing pattern, which told me that this should resolve higher, and this isn't going to be the start of a large, maybe primary degree wave 2, such as we were looking at a few weeks back. We found support at about a 50% retracement of the 5-wave rally from the March 4th lows. So there's your 5-wave move in the direction of the higher degree trend. Here's your 3-wave counter trend corrective pullback. You'll notice the counter trend corrective pullback was equal. We had equality of waves Y compared to W, which simply means the secondary leg of the decline is equal to the initial decline off of the highs. So if you were to just simply measure that, project it from the retracement and log scale, you'll notice that's where we found support. 3-wave measured move into a 50% retracement, taking you off the 30-minute chart and now down to a 15-minute time frame. Zooming in, you'll see that we have, from the March 25th low, a completed 5-wave trend. On the 25th of last Thursday, we put out a video with this count suggesting we were going to start to rally. I put out a video on Monday pointing out the fact that we were either at or near completion of this 5-wave move. And with yesterday's price action, we now have the wave 2. So the 3-wave corrective pullback against now this 5-wave trend is in development. You have a move down in a beautiful counter trend 3-wave correction here in B. That took you to a 61% retracement. That also gave us a confluence with the C versus A equality inside of green wave B. So dissecting, decomposing that B wave, looking at the A wave, again, just the same concept that I showed you here with the Y versus W, we're doing the same thing here inside of green B with the C versus A. So that gave us 39.67 as an area of resistance. The market retraced into that yesterday, and we did see a nice little push out of that zone towards the end of the close. What I'm going to be watching this morning, futures are about flat, but What I'll be watching this morning is the likelihood that we do continue lower here in C of wave number 2. Downside support, the initial kind of area of support that I'll be watching is 39.30, and that is going to be equality of this green C wave compared to A. So the same concept I just showed you here in this 3-wave subdivision, and the same concept I just showed you there on that 3-wave blue decline there. Now, just because equality of C and A is at 39.30 doesn't mean we're necessarily going to stop there and immediately start a reversal. The more traditional wave 2 compared to wave 1 retracement levels include a 50 and 61% retracement. A 50% retracement, as you can see down here at 39.17, that would take you right into the area of the previous 4th, which is also another very common support level to be watching with any counter trend pullback. So I'd be looking for support initial 39.30. If that breaks, we've got 39.17. Below that sits the 1618 of C compared to A. That's another very common fib relationship between the secondary and primary corrective leg. And you'll notice the 1618 of C versus A sits right between the 50 and 61% retracement of the 5-wave rally. Now, wave 2s obviously can take you to a variety of retracement levels, which means this technically remains valid as long as we trade over the origin of the 5-wave trend. I don't really want to see a move south of 3,900. If we get south of 3,900, that's going to open up the 78.6% retracement of last resort. And if we get south of that, that's going to then make this trend a little bit questionable. But as it stands, I see a very clear 5-wave rally coming to completion, a little bit of a 3-wave pullback. And I think that regardless of where this fits into the higher degree wave count, it's going to present a tradable entry opportunity. And as we've talked about before, in terms of being conservative in your Elliott wave interpretations, let's not even look for the 3rd wave typical upside projections. What I'll do once this 3-wave trend completes is I'll simply project equality of that initial move from this pullback, and I'll look to set up a trade to carry us through the highs. Go out 14 to 21 days, pick up an upside call spread to carry you through that zone. So that's the S&P. Things are a lot more clear here in the S&P. The Nasdaq is still a little bit of a question mark, and let me show you why right now. So first of all, in the Nasdaq, we have a couple of potential wave counts at work. I'm going to first show you the possible bullish interpretation. So here on the daily chart, off of the February 16th market high, we have a 3-wave measured move correction. It doesn't get any more clear than that in terms of equality of that C wave compared to A. Off of the daily, we're going to focus in on everything that's happened from the March 5th lows. You'll notice the 61% retracement of this decline at 13,215. That's been your primary area of resistance. We've yet to break north of the 618 retracement, whereas the S&P has actually managed to print a new high. So off of the daily, we'll go down to a 1-hour chart. We do have a 5-wave trend, a 5-wave rally off the March 5th low. So you have 5 waves up, and we've been in this kind of sideways to lower 3-wave correction. What I'm wondering if is going to happen is, as I just showed you in the S&P, I'm looking for that C of wave 2 decline in the S&P. Is that going to give us a move through the A wave here in the Nasdaq, which could then take you back down into this zone of support? You've got the 61% retracement right here stacking up with Y equality to W. So I could totally entertain the idea that maybe we are going to get that second move lower. And once this correction comes to completion, if we do start to move higher from there, we still might not be out of the woods even then, because the alternate is that the move off of the top was just part of the correction. We're in some sort of a B wave, and then we get that secondary decline in C. So I'm still a little bit unsure with the Nasdaq and tech. Remember, underperformance with the situation that we have in yields, so underperformance of growth in tech stocks doesn't necessarily mean you should be void of all exposure, and it doesn't necessarily mean we're going to go into a bear market correction. So over to the XLK, you'll notice we have a very similar wave count. The NDX Nasdaq 100 being, I think, 48% or so weighted in tech specific names, pure tech plays. We have a very similar wave count. We have 3 waves off of the March or the Feb 16th high into the March 5th low. We've got 5 up, and we've just kind of been in this sideways correction. We've yet to break the 61% retracement. I will say that price action out of the WXY 3-wave correction here. So you've got ABC down, 1, 2, 3, 4, 5 up, ABCW, ABCX, ABCY. That took you to a 61 past the 618, just shy of the 786. You'll notice from there, if I take you down to like a 15-minute chart, we can get 5 waves up here in the XLK. So maybe the Nasdaq doesn't get that second wave to the downside. For that reason, for the fact that we do have some lack of clarity here, I'm just going to focus here into the S&P and look for that next upside trade opportunity. Russell 2000 small caps also look rather healthy. We've got a 3-wave correction against the trend. Let me see here. So here's your 3rd wave top inside of an extended 5th wave on the daily. We have A, B, C. You'll notice if I just quickly erase these ratios and bring them back in, we have C versus A equality, and that took you to equality of 4 and 2. Off of the daily chart, let's see if we can get a motive wave out of that correction, that ABC flat. You'll notice we do have 5 up and 3 down. This could just be A of 2, we get B of 2, and then C of 2. But regardless, I'll also be looking at the Russell 2000 for a potential reversal. Terry was pricing out some really good trades that I like on the upside there. So we'll keep our eyes on that. Let's bring back in the team. And Terry, you want to get ready, take the screen? I think you've already got the screen, don't you?
Oh, I'm ready.
You're ready? All right. So yeah, that's it. That's it for me on the hard right edge. We'll jump into sector focus. After sector focus, we'll hear from Alex on the macro front, as well as a little bit of a crypto update. Of course, he does have his show tomorrow. So Terry, Mr. Long, let's do it.
Hello, traders. I'm Terry Long here with your weekly sector focus. We'll start with a quick look at last week's performance of the index and sectors. Now, last week, the indexes moved lower early in the week, but they found support and rallied back strongly on Thursday and Friday. The S&P returned back to its all-time high levels. This red line up here is its all-time highs that were made just the prior week. It gained 1.5% on the week. The Nasdaq ended the week up 0.87, had a similar decline early in the week, a rally on Thursday and Friday. Now, last week, the communications sector was the week's biggest laggard, falling just over 4%. And staples, real estate, and technology materials, they led the S&P higher last week. So it was a pretty big week, all except for what happened here in communications. Now, so far this week has been a fairly quiet market. The S&P down just 0.4%. The Nasdaq down a little bit more, down 0.64. But you can look at these candles. You can see how thinly the price action has been for each one of these days. Here, I'm going to show you Monday, cumulatively Monday and Tuesday's price action here now. We have energy down 2%, technology down about 1.5%. Those are our sector laggards so far going into the week. Communications getting bringing back about 1%, so it's a bounce off of that big drawdown last week. Our sector leaders remain energy, financials, and communications, industrials, and materials here. Now, the communications sector here is still rising into this leading quadrant, but you'll note that its upward velocity has visibly slowed as leading stocks in that sector saw sharp drawdowns last week. And like I said, the communications sector underperformed all sectors last week with 4% dive. Sector leaders Viacom and Discovery Channel declining precipitously as the details of over-leveraging from hedge fund Archegos are revealed. Now, these stocks lost nearly half their value last week. Bill Huang, CEO of Tiger Management's at the center of this investigation. So reportedly, Credit Suisse, Deutsche Bank, Goldman Sachs, and other large banks are also getting hit for their overextending leverage to Huang. Take a look inside the communications sector a little bit closely here in a moment. First off, energy and financial stocks continue to show momentum decline while still retaining their high relative strength, but you can start to see weaknesses coming in. So declining momentum both in these two leaders. Now, the industrial sector is seen climbing northward, and if I animate it back a little bit, you'll see we formed a hook back here February 26th, back to the north, pushed a little bit into the lagging quadrant, back into the weakening, and now back up here strong. This is going to be a lot of the stocks in here, I think, are infrastructure plays, and they're actually doing quite well. Materials sector retains a leading trend indicated here by the green color of the vector. However, it's had this southwesterly heading. It's just kind of been meandering. If you'll look here, a little bit of an animation. It's tried to move up, moved sideways again, moved sideways, and now it's pointing up on this very last tick is Monday and Tuesday's price animation. So obviously the last tick here is not closed until the end of the week. We do have a short trading week. But we are seeing materials and industrials at the moment now both pointing higher. Now, the technology sector, I'm going to zoom in a little bit even closer here and show you what happened here. I saw the technology sector showed just enough strength last week to form a small reversal hook. The tech index just penetrated into the lagging quadrant last week with this new formed hook, but then reversed lower again. So now we've got, if I add the last Monday and Tuesdays in, you can see Monday and Tuesdays got technology in the decline again. Now, I think it's early, probably too soon to call for a recovery in large cap growth stocks. However, we are following the breadcrumbs and the telltale signs of a path likely in reversal. We'll see what the shortened trading week brings as the first quarter of 2021 does come to an end. Now, the consumer discretionary sector is still pushing deeper here into the lagging quadrant, and we haven't really seen any clear signals of this trend reversing. We're still seeing a push to the south deeper into the lagging quadrant. Up here in the improving quadrant, the real estate sector continues to rise higher in this improving, but the upward velocity was beginning to slow down a bit. So it's not, it is turning a little bit eastward, which is a positive thing because now that means we are starting to gain more relative strength. Now, healthcare has joined staples and utilities down here in this lagging quadrant. The utilities sector actually formed a reverse hook here back to the southwest. Well, that's just indicates continued lagging performance here. Now, the staples sector is deep down here in this lagging quadrant, but is showing vertical movement indicating rising momentum. And we are just now on the edge of moving up into the improving quadrant. There's a lot of momentum coming up here in this improving quadrant here. Let me go ahead and run through a couple. I don't want to cover all of these sectors, but I want to show you what was going on in at least the communications and financials. So how appropriate was it that I covered the communications in detail last week and showed you the signal even before the announcement of Huang, and even before the price on these stocks started precipitously falling, we had already seen a rollover in the momentum and relative strength. So this vector had already turned, and then last week it pushed deeper, right? So all that happened like on Thursday and Friday of last week with these two stocks. Let me pull the price charts up. Both of these guys lost over 50% of their value. And it was really curious. It was really a nice steady run up in both these stocks, but I think a lot of people were wondering why. There's really not a lot of new content. What were they really getting a new subscriber base going? What was driving this? And it was all hedge fund over leveraging. Some of the banks were loaning Huang up to 8-to-1 and even 20-to-1 against some of these. So he got a big margin call, multi-billion-dollar margin call last week, and we saw Viacom drop from 100 all the way down to 40, and you can see a little bit of a bounce going on right here, Monday and Tuesday's price action. The same kind of thing happened here in Discovery. I don't think Discovery was hit quite as hard. Discovery got up to 65 again. It had been pushing a really nice, ever since about October, really nice uptrend going, kind of accelerated here in February a little bit, the slope a little bit steeper, and then there's the collapse, right? Now this collapse has come back, and I pinned a support level here at the $30 mark. So we'll see whether this is the completion of the correction or if there is going to be more to follow. Now, likewise, several of these large bank companies, we'd also noticed that, I'd also told you that the financials had started rolling over, and they did this earlier, right? So I'm going back here to early February. You can see a lot of these down vectors in a lot of these large bank stocks anyway. So this movement down in the bank stocks is not only due to what happened last week, but certainly several of these bank stocks, Morgan Stanley, Goldman Sachs, JP Morgan, they were all involved in some way that I understand in providing capital over leveraging, as well as Credit Suisse and Deutsche Bank. So these guys are taking a bit of a hit. Let's take a look at Goldman Sachs. I don't really see a lot of price depreciation here in Goldman. So, but you can see the consolidation coming off of the highs here. And let's take a look at Morgan Stanley. So these guys had big run-ups here. They're just in a bit of correction. Looks like we're actually finding some support level here at 76, and I'm bouncing off of that. So I'm going to leave it there. I'm not going to go into all the sector detail. We do that, leave that for our clients, and we'd love to have you guys join us as a subscriber for our daily strategy videos and our weekly webinars. We're going to keep a close watch on these sectors as the first quarter of 2021 comes to a close on this shortened trading week. U.S. markets will be closed April 2nd to observe Good Friday. Back to you, Bennett.
Thank you, Terry. Much appreciated. All right, Alex, what's happening, sir? Terry, could you pass him presenter? You ready to bring us up to speed on what you're seeing in Alex's world? All right, you got the presenter. All right, let's jump into it. Here we go.
Hey traders, let's look at a little bit of what's going on the macro picture. As always, we're going to start with the US dollar index. And if you remember, we looked for two distinctive options which were left. First one was that we have a little bit more downside in a potential fifth wave, and the second one that we are going to basically morph into a more impulsive move on the upside, looking this higher degree possible correction in dollar. And I think we got that. We crossed the key 93 levels. So from the March 2020 COVID crisis, we are counting this as a 1-2 down in 3, pullback in 4, and move down in a wave 5, which finished around 89.16. And then from there, we have a little bit of more hesitant move up in the dollar. As we look where the yields are, you can see clearly on the dollar-yen chart that the yields was clearly displayed there, much more aggressive than on the dollar index. And we are still looking for a further move on the upside. I'm expecting a little bit of a pullback. We passed daily 200 moving average. I think we are very close to this completion of the possible green wave 3, and I'm looking for a little bit of pullback in a green wave 4, and then a final completion of this potential A wave move around, let's say, 94, 95 levels, from where I will expect a B wave correction in some form or the other, and then a further move up in this potential C wave on the upside, which will possibly go to 97, 98 levels. We still cannot measure that since we lack the first A and B move to correctly see where this price action in dollar might take us. So as you can see, this is a very slow process. I was expecting a little bit more bigger impact or a more faster move in this wave A, but we didn't got it. And as you can see, we are moving from January 7th and we are already in March and we didn't even trace the first 5-wave move. So I think we are going to see a little bit more prolonged move up in the dollar. It's going to drag its feet. First, we have to do a first 5 waves. We need a few more subdivisions, then a B wave down. If this B wave gets to be a triangle, it's even going to take more time. And then a C wave in a simple ABC form, it's going to take us down to September, October 2021. So don't expect this to finish very quickly. According to what we look now, this will be a several months process while we see this corrective move up on the dollar is finished. We're going to address, of course, all of the steps in our TA Wednesday show, as you can see here. So we're going to track this B wave and then a further move up in a C wave. There is still several possibilities here in a sense of how this correction can outplay, but let's go with a simple ABC. So overall, as you can see, RSI is a little bit on the upside. I expect a pullback and a move up in this 5th wave, as I said. But the overall wave count played out relatively nicely. So you can see a clear 5 waves down. Some of the Fib ratio are nice. We expected at the first glance a little bit more lower. We didn't got it, but we adjusted on time and presented this possibility on the upside. So as you know, 10-year yields are moving up. We are trading at a key 1.8 level very closely, and there is a very big resistance area there. If we go through there, then the things are going to start to be very different in that respective. We have a request for oil wave count. I'm gonna show you what I'm seeing on 1-hour chart, and I think this one is now very valid one. As you can see, we have some type of a 5-wave sequence possibly in development. So there is a wave 1 up in wave 2, relatively nice visible subdivisions in the wave 3, ABC pullback in the wave 4, and I'm expecting possibly a wave 5. It still needs to prove itself. So my target for the possible wave 5 is around 54, 58, or let's say 55 level. After I should see an ABC pullback. But what I'm saying here, if we see an impulsive move in oil on the downside in a 5 waves, then you can sure expect after a corrective pullback another move down in oil for the possible C leg. So watch carefully what will happen here. If we continue and if we break these lows at 57.34. This is the VTI light crude oil futures. Most probably that will be a five-wave sequence. After a pullback, we're going to see a more weakness in oil. As I did this chart, I did some key fib ratios, and they're kind of placing on this wave 3 projection very nicely. 1618 for the wave 3, 5 waves up, 3-wave pullback, and then another 5 waves up, possibly in this small ending diagonal here. And from the highs here, and we kept it above below a little bit of this wave 1, which is within the Elliott wave rules. So watch this very carefully. If you see a 5-wave move, you're going to see a continuation move down in oil. So let's go and see gold. I just saw this chart, Bennett. This is interesting one on the trading view from 1834. It's a huge timeline on gold. A short term, what I see on gold is, as I looked the dollar yen, which is very correlated with the gold, we can see this correlation functioning in the past very perfectly. This was the high in gold in 2011. This was a low in dollar yen. Then we moved up in dollar yen, and gold fell down. And then this repeats. We had a little bit of discrepancy here, but now we are back into the correlation, and as the gold is moving down, dollar yen is moving up. So I would even consider this to be a little bit of a bigger triangle, possibly for the several next months, as we see a corrective move in dollar and upside in dollar yen on account of yields. So I won't be surprised if we do ABC down, another DE, and then in the some years ahead, possibly 2022, gold can finally continue on the upside. On the more directional wave count, we should keep this 38.2% levels. This is a more directional without triangle. I'm now looking these two options. We should find support soon and move higher. But looking at the yields and the correlation, possibly that will not be the case. But anyhow, we don't want to be kind of on the back foot. We need to have several wave counts to cover the macro possibilities. As the Bitcoin is concerned, people are, I see many people in the news calling this 170, 50, 180K to the end of this year. And guys, I still gonna pursue my 200 level as the potential final target for this blue wave 3 on the Bitcoin. From the January 2019, we have a 5 waves up in one, down in two, and then the progression in a third wave can basically stall and stop in these several fib ratios that we look. 1618 we surpassed, equality we surpassed, so there is two left. The other one is at 75, 74, 75,000, and this one 2618 is far much above. And as you look the situation with COVID and vaccines and a little bit of normality, we might start to be, maybe we are going to see when the situation normalizes even further, yields pushing higher. And I think that will also influence Bitcoin, and that we are going to fall in a more bigger correction in this wave 4, even to July 2022, if these levels hold. So I'm expecting a little bit of move of back and forth in this 4-wave possible correction, move up in 5 to these 75 levels, and then I'm expecting a bigger correction, which kind of starts to fit very well in this macro overview, that we are going to see a little bit more inflation on the horizon. The Fed will stay neutral, inflation will go above 2%. As we normalize, of course, people will go a little bit more of a trading floor, spend more, enjoy a little bit more of traveling and all of this stuff. So I won't be surprised if this puts Bitcoin in a more of a kind of a this triangulation in this fourth wave before we start to move higher. So I'm not expecting the move up immediate one, as many people called it. I'm expecting a 4-5 and then a big wave 4 and then a further continuation on the upside. So that's a little bit of a mix in a macro with Alex. So back to you, Bennett.
Thank you, Alex. Much appreciated. Terry, Alex, nice show. We made it. The market's just open. We'll keep our eyes here on the opening tape. And members will be with you guys in about half an hour for the Premier Trader member webinar. Thanks again for tuning in. If you guys did enjoy the show, give it a like. Let's the YouTube algorithm know that you are enjoying the content and distributes it accordingly. You can subscribe and turn on notifications to stay up to date with Todd. He has the Series 65 this afternoon, so wish him luck. We'll be keeping him in our thoughts, and you can check us out at tradinganalysis.com. Yeah, it's a long exam. It's gonna be an interesting one.
You took that practice exam, right, Bennett?
Yeah, I took practice exams on different sections. I didn't do the entire test at once. That would have been.
Well, you didn't even study for it.
I was just doing it for
60%.
Doing it for fun.
How big is that book, Bennett?
It's pretty big. It's a 3-hour test. So.
Oh my God.
Yeah. So we'll see how it goes. Hey. Anything else you guys can think of before we let them get out of here?
That's it. See you guys at tradinganalysis.com. Check out Alex's Crypto Lab tomorrow at 9 a.m. on our YouTube.
Yeah, we will go deeper into this crypto scene. Many things are happening, so please join me and fall back. We do some work for you as well as we do always.
Absolutely. Check it out, tradinganalysis.com. You can sign up for our mailing list there. And then, of course, if you want to stay up to date with our public content throughout the week, youtube.com/tradinganalysis. That's where Alex will be hosting his show, 9 a.m. Eastern tomorrow morning. Thank you guys for taking time out of your Wednesday, and we'll see you guys all next week. Take care. Have a good one.
See you guys. Bye. Bye-bye.
Hi, if you don't know me, I'm Todd Gordon. I worked in the trading markets as a profession and a passion immediately following college 19 years ago. As I've grown older, my trading and investment style has changed. As I've grown as a trader, my holding period for my investments was also growing longer. I was learning firsthand that being properly allocated in the right stocks and sectors on a longer term time frame with proper hedges in place and the idea of compounded returns are the keys to building real long-term wealth for most of the investing community. You can short-term and swing trade the stock and options market if you like, but do so with a very small percent of your capital. And by no means should you be trading with a majority of your investable assets or your portfolio. For our clients in Trading Analysis, we recommend that you don't trade with any more than 20% of your portfolio in the strategies for our members at tradinganalysis.com. The rest should be managed by a professional financial planner. So last year I ventured out to make a final evolution of my career in the markets. I left the very capable team at Trading Analysis that I built to run the day-to-day operations. I set out to build a wealth management business leveraging our reputation from CNBC and our years in the financial markets. We'll be launching soon, so please keep an eye out for details. If you'd like to be updated as information becomes available, please visit www.tradinganalysis.com/investments. Again, thanks very much for your interest. Look forward to what the future holds. Cheers, and let's get back to the live stream.